Africa is experiencing a population boom. By 2050, the continent will be home to 2 billion people from 1 billion in 2010. In the next 40 years, approximately 800 million Africans will either migrate or be born on the continent's urban nodes, leaving a need for people to occupy homes and have offices from which to work from. According to Buno Property Investment Group, there are 3 key markets on the continent. Each region represents exciting investment opportunities. For example, Ghana and Nigeria in the west offer high investment returns. Kenya in the east, which can be used as a base to expand elsewhere in the continent, and Zambia's attractive investment incentives in the south.
Thankfully, there are investors out there that are inclined to agree, and really that potential is derived from a huge demand-supply mismatch in certain subsectors of the real estate space that we've observed over the last few years.
With the African consumer becoming more sophisticated, there's been a growing trend towards the need for convenience. Consumers are looking for a one-stop shop, and there's now a clear evidence of the transition to formal from informal shopping centres.
The normal shopping trends of shopping in small plazas, this market, is now being overtaken by access to the shopping retailing centres. And obviously, yes, retail sectors or the retailers themselves are seeing a lot of potential in that. They are going out in great numbers into Africa, especially the South African companies.
Although investors are moving into this retail space, accessing funding for property development in parts of sub-Saharan Africa still remain a challenge. Developers often need to put down a 50% deposit to fund these projects.
In addition to developers facing the difficulty of having to put a larger proportion of the total project cost in as equity, which is inhibiting in itself, there's the added restriction of undeveloped debt markets in the types of jurisdictions that we're speaking about. That translates ultimately into a higher cost of debt, so debt spreads of between 750 and 950 basis points. And in addition to the higher cost of debt, or probably contributing to that higher cost of debt, is the fact that you've got a limited number of debt providers.
Once developers are able to move past the funding hurdle, among other regulatory red tape that may exist, huge successes may be achieved. For example, the Accra Mall in Ghana, which has an occupancy rate of almost 100% and has been a source for employment opportunities. At a time where the Western economies are faltering, the prognosis for Africa is still positive, which makes it the obvious choice for investors looking for higher yields. Timisha Mahanyele, Johannesburg.
Joining me in studio now to take a closer look at property investment and development on the continent is Louis Depper. He's Director for Real Estate at Actis, and Elvis Ndimorokondo, who's Africa Strategy at Jones Lang LaSalle, joins our conversation as well. Thanks so much, gentlemen, for joining us today. Perhaps let's start off with you, Louis. I've come across article upon article saying African real estate is becoming increasingly popular as an investment asset class as skylines grow in major cities. Now, that sounds pretty poetic. Just how much of an investment drawcard has African real estate become?
I think over the years, real estate in Africa has certainly received a far greater percentage of the attention over the last few years. What we've seen in raising our funds as well, we're well into our second fund. We've just closed that out at just under $280 million. And essentially the appetite that we've experienced from there indicates that there is a market beyond South Africa. There's a market in the States, there's a market in Europe that is actually feeding into the African and buying the African real estate story. Mm-hmm. And that gives us the firepower through the second fund to actually start deploying that capital base on real estate projects, and that is pretty widespread. We have a geography that's sub-Saharan Africa, so it's not only the quantum of cash you have, but it is also the spread of projects in the different jurisdictions that we look to, that I think it attracts that investor base.
Elvis, Louis touching on things in terms of a geographic perspective and where that interest is being directed. When it comes down to the various components that make up the real estate sector, though, whether it be retail, office, hotels, business parks, are we seeing that interest across the board on that basis?
From my point of view, we definitely have seen a lot of interest, mainly in retail, as it's been pointed out. Mm-hmm. But we we're also focusing also on the office space, that where the demand is also rising and supply will eventually catch up with that. Of course, the primary focus has been retail, was driven, of course, for the consumer market growing also. But now we are seeing more and more services, industries focusing on servicing industries, the way we should look at an office space, also growth in that particular sector of the real estate, as well as warehousing.
Just how competitive a landscape are we looking at? Are we looking at a crowded market?
It's still crowded for the office space. The few developers that are available are still delivering, good stock in terms of office space, but the prime office space is still relatively short in supply, and I think that the best developers, whether being local or international, are looking at the growth on the continent. I think Louis can.
I think just
shed
to
more
add,
light on that.
Just to add, one of the areas we focus predominantly into two spaces, one being the commercial real estate and the other one being retail. And when you look at the retail, it is a sexier asset. It attracts more glitz and glamour. You have the brand names, the fashion statements, so it does have more allure to it than the office market. And I think for us, what attracts us to this environment is, simply put, the demand-supply imbalance is just ginormous. I think you could bring a whole bunch more players into the environment and you still wouldn't be able to meet the demands that are available in the market. So this is not a demand constrained environment, it's a supply constrained environment. And as we saw earlier in the video, the supply of capital, the supply of skills, resources, the difficulty and challenges of these markets have certainly added to make this a more attractive investment class from a yield perspective, but also it makes us focus a little bit more in terms of what we're doing. So we focus predominantly offices and retail, and then we could blend it with a little bit of mixed use in between, but essentially the core focus is those two sectors.
How do you weigh up the risk against the opportunity, and where does that risk scenario stand in contrast to perceptions about risk?
I think on the African continent, I've been personally traveling Africa since 1999. Have seen dramatic changes throughout Africa. Going into Dar es Salaam and seeing people begging on the side of the streets in 1999 to where they are today, where there's probably less beggars than there are in Sandton. I mean, it's a remarkable change. The GDP growths in these countries have led to phenomenal changes. So trying to balance the return profile and the perception of risk, I think the perception is completely flawed about Africa. There are hurdles. None of them are insurmountable, and I think it just takes a will and a passion to actually bring it about. And looking at the different opportunities and weighing up which is the right angle or which is the right area to invest into, I think a large focus is around where do you make your returns. Obviously that's a key driver, but essentially there's a shortage, so you could pretty much do anything in those markets and you would still make a decent return.
Of course, we've had Louis there touching on the perceptions about risk. Speaking to people who are delving into the real estate space out there, Alvis, what kind of sense do you get about what they're thinking about the risk scenario they're actually entering?
I think the risk factor is actually, if we could categorize it, in terms of commercial risk and political risk, and other risk associated with real estate. We're seeing less of the commercial risk in the retail sector, as Louis pointed out. When you've got retail, shopping centers being fully let, rather the onset when they're actually being developed, then you're addressing the commercial risk. And in the office space, you're still seeing a bit of the commercial risk where capacity levels are still slightly higher than the actual retail sector. Yet that also will still come down in future as the growth pattern of the rest of Africa picks up with the GDP growth that we're seeing coming on stream. Political risk, of course, some of the investors, international investors, have had issues with the political risk associated with investing on the rest of the continent. But there's some progression in terms of democratic inroad of some elections coming across. The likes of Ghana, where we've seen successive elections coming on stream and being dealt with. So I think that should definitely be addressed.
Louis, how do you mitigate against some of that risk by finding the right local partner, someone with the on-the-ground knowledge and experience, or do you go it alone?
I think different markets, you can take a different strategy depending on the market you're in. I think we've been very fortunate. We spend a lot of time in evaluating our partners and what we want to achieve out of it, what they want to achieve, and we align ourselves very clearly with the partners from the outset. So I think we've been very fortunate in the relationships we've set up in Ghana. We've had some fantastic successes, as you saw earlier, Accra Mall. We've done developments in Nigeria with very, very successful businessmen, and those have also been very successful relationships. I'm using the word success a lot, but in essence there is a huge value to be put on partnerships. In places like Dar es Salaam, we've actually bought out our partners who didn't want to participate in the actual second phase and expansion of whatever projects we were doing. So, there we went it alone, and it's a different strategy for a different market. And I think in West Africa, certainly it is more of a partnership environment because of the challenges you face in the local legislator, etc. You need people on the ground, and that's one of the reasons why we've actually set up 2 development platforms, one in East Africa and one in West Africa, which is there to actually facilitate and allow us to deploy our capital faster, because primarily we're not developers, we are investors. So we put the money, we're the guys with the private equity that bring the equity to the transactions, and that's where we want to play. We don't play in the development space. We will back developers and fund developers.
Yeah.
So that's been a very successful area for us, and to sit with partners and making sure those partners are the right ones is a vital position to be in.
Of course, I know that I'm not going to be able to get you to share just how successful Actis has been when it comes to the investments it's made on the continent, but the fact that we've seen total commitments with the second real estate fund of $287 million being tabled, does demonstrate the kind of success you have enjoyed in the past. Perhaps that relationship with a local partner on the ground, Elvis, a particularly important one to develop and foster when it comes to navigating the regulatory environment in these various territories. I mean, the laws governing the ownership and taking of security of real estate in almost all African countries, I mean, they limit ownership of sale of land. Just how tricky does it make investing in this space, do you think?
From where we come from as Jones Lang LaSalle, we operate in the primarily in the office, servicing the office in market, in tenant representation, and in agency and brokering. We really progress by looking at a good partnership, a local partnership, where that they can help us in addressing some of the issues, as you pointed out, on the ground on behalf of our clients. Now, going forward, we're looking at more setting feet on the ground to address particular needs of our clients, global clients that are looking at investing on the continent or expanding their operation, requiring more premises on the ground. That comes again with the demand of a local knowledge or market intelligence that you can only actually get by aligning yourself with an actual practitioner on the ground.
Yeah.
The days of flying in with a briefcase are numbered, and this is where we're seeing more of actual requirements from our international global clients to be on the ground and actually addressing the specific needs.
To what extent is it impacting the number of tenants we're seeing on the continent as opposed to owners? Because surely this having quite a bit of an impact.
Well, that was, I suppose, I mean, in the space we play, depending on what the client need, of course, one can actually rent or actually own the premises, but it depends, of course, on the case by case and country by case, and also the laws. Some countries might not allow an international company to own property, therefore requiring an actual local ownership or local investor to own the asset and then lease it to the international company coming into the market. I mean, that really depends on country by country, where there's some restrictions. In Ethiopia, it's quite restricted in terms of outside business parties coming to the country. So that's something that you will still look at.
Well, let's leave the conversation there for now. At least we're heading into a quick commercial break, but more on Invest Africa when we return, so stay tuned.